Hello, you're watching Dukascopy TV, and today we're examining market reaction to last week's, some might say, surprise cutback of $10 billion in tapering by the Federal Reserve. Well, joining me on the line from New York is US economist at BNP Paribas, Yelena Shulyatyev. Yelena, could you just briefly bring us up to speed with reactions you've seen in the market since the FOMC announcement, especially as it seemed to take a lot of analysts by surprise?
I think the market's reaction is not caused by the FOMC decision alone. I think it's a combination of things, and in fact, it could be a combination of a potential economic slowdown in China. It's just that the FOMC decision came at the wrong time. Ironically, it was well telegraphed, well ahead, and I think the Fed delivered exactly what was expected. It's just that the timing of this coincides with other potential, bad things happening, and it's just that toxic cocktail for emerging markets that causes all these market reactions.
We've seen Japanese stocks plummet. There's a similar growing picture in Europe, and China's once again slowing down. Do you think this recent announcement to cut so soon was premature in any way?
Well, I don't think so. I think what the FOMC is supposed to do and what their dual mandate is predicated on what's happening in the U.S. And this is the only thing, to a certain degree, obviously, but this is the only thing they're supposed to do, and they're supposed to look at how the domestic economy is doing. So obviously, if these market developments end up basically in a liquidity crisis, in a big contagion, global contagion, that will affect the U.S. economy as well, and at this point, the Fed will have to react. But I don't think at this point we see anything like that yet, and they are certainly watching it and watching it every day.
But the Federal Reserve knows what sort of an impact it can have on the world and the markets. I mean, Janet Yellen could just open her mouth to say one word and everyone would turn their heads. What if I was to say that this decision by the Fed to cut back so soon is hampering or stalling a global economic recovery and has created a bit of a shock reaction in the markets?
I don't think it was a shock reduction. They telegraphed it very well in advance, and they told us they will do that. They don't feel comfortable with QE policies. They would like to get back to their regular policy, the rates policy. And they did tell us, and they did say measured pace, right? So I think that's what they are going to do, and the bar for doing anything other than that is very high. I mean, yes, we did see a market correction, and it's quite a large one, but it's not as large, as to cause them to stop. I don't think, unless we see something like a 10-15%, maybe more correction in stocks, they will stop. That's probably what we are going to see, that they will continue taper at a measured pace.
Just quickly before we close, do you think the markets have had it too good with regards to easing since the global crisis hit, and it's back to normal, if you can call it that, from here on in?
That is absolutely true. I agree with you. The markets and countries, emerging countries, were given a chance to do something with the economies. At the time, the Fed was super easy, right? So they had to, start investing or, rethinking how the economies work. And, at this point, we're just getting back to normal, as you mentioned. So, QE cannot last forever, and the Fed was pretty clear about that they would like to exit this policy. So the option is very clear, right? This is the only way. We need to get used to it.
Okay, thanks for joining me today from New York, Yelena. Don't forget to check out all our other exclusive interviews and updates here on Dukascopy TV. But for now, goodbye.